Before the headlines, before the panic, before the rumors racing across social media, ask yourself this one question. What if the story you've been told about Yarport China's so-called financial crash is only half the truth, and the real danger isn't the billions lost in silver and gold, but the system that made those losses possible in the first place? Imagine waking up to news that a major Chinese financial powerhouse tied to precious metals has been hit with catastrophic losses, numbers so large they sound unreal, and suddenly investors everywhere are asking whether silver and gold are still safe, or whether something much bigger is breaking beneath the surface of the global financial system. This story doesn't begin with a single bad trade or a sudden price drop. It begins years earlier, in an era when China was aggressively positioning itself as a dominant force in global commodities, especially silver and gold. Yarport China, often described as a financial conduit rather than a traditional bank, built its reputation on facilitating large-scale metals trading, cross-border settlements, and leverage-heavy strategies designed to amplify returns. In simple terms, imagine borrowing heavily to buy gold and silver, expecting prices to keep rising, while using complex contracts to delay actual delivery. On paper, everything looks profitable, but in real markets, paper promises only work as long as confidence holds. To understand the scale of what allegedly went wrong, we need to talk about how silver and gold markets really function. Most people think these markets are driven purely by physical bars and coins moving from vault to vault. In reality, the majority of trading happens through futures contracts, options, swaps, and unallocated accounts. These are essentially IOUs, claims on metal rather than metal itself. For every ounce of physical silver in a vault, there can be dozens, sometimes hundreds, of paper claims. This system works until too many people demand delivery at the same time. Then the cracks start to show. Yarport China's exposure reportedly sat right at this fault line. As global silver prices surged during periods of inflation fear and geopolitical tension, the firm expanded its positions, betting not only on higher prices but on continued liquidity in Western-dominated exchanges like COMEX and the London bullion market. At the same time, China's domestic demand for physical gold and silver was rising, driven by households seeking protection against property market weakness and currency depreciation. This created a dangerous mismatch: large paper positions tied to global pricing mechanisms, and growing physical demand that wanted real metal, not settlement in cash. When silver prices became volatile, swinging sharply on interest rate expectations and central bank policy shifts, leverage turned from a weapon into a trap. A small percentage move against a leveraged position can wipe out months or years of gains. Reports suggest Yarport faced margin calls running into the billions, forcing it to either inject fresh capital or unwind positions at unfavorable prices. In gold, the story was similar but even larger in scale. Gold is often seen as a safe haven, but when liquidity dries up, even safe havens can fall sharply as investors sell what they can, not what they want to. Now add another layer: currency risk. Much of Yarport's metals exposure was denominated in US dollars, while its balance sheet and funding were deeply tied to the Chinese yuan. When the dollar strengthened, the real cost of maintaining those positions increased. Think of it like taking a mortgage in a foreign currency. If that currency rises, your debt effectively grows overnight. This dollar strength, combined with falling or volatile metals prices, created a perfect storm where losses multiplied faster than risk models had anticipated. But here's where the narrative becomes more complicated and more interesting. Was this truly a crash, or was it a controlled failure, even a strategic sacrifice? China has a long history of allowing certain entities to absorb losses quietly while protecting the broader system. Unlike Western markets, where failures often play out publicly, Chinese financial stress is frequently managed behind closed doors. Some analysts argue that the billions lost figure may reflect mark-to-market paper losses rather than realized physical losses. In other words, the metal may still exist, but its paper valuation dropped under accounting rules. This distinction matters enormously for investors. If the losses were primarily on paper contracts, it suggests stress in the pricing mechanism rather than a disappearance of real wealth. It also raises uncomfortable questions about how much silver and gold actually back the global trading system. If a single entity's forced unwinding can move prices dramatically, what happens when multiple players rush for the exit at the same time? Historical context helps us here. In the 1960s, the London gold pool collapsed when central banks could no longer maintain an artificial gold price. In 1980, silver markets were rocked by the Hunt brothers' attempt to corner supply, leading to rule changes and sudden price crashes. More recently, during the 2008 financial crisis, gold initially fell as liquidity vanished, only to surge later as trust in fiat systems eroded. Each time, the lesson was the same: price volatility doesn't mean the metal has failed, it often means the system around it is under stress. Yarport China's situation fits neatly into this pattern. The alleged crash coincides with broader fragility in China's financial landscape, including property sector debt, local government financing issues, and slowing economic growth. Precious metals were supposed to be a hedge against these risks. Instead, aggressive leverage turned a defensive asset into a source of instability. It's like buying insurance and then gambling with it at the same time. So what is the real truth? The real truth is that silver and gold didn't suddenly become worthless. What failed was a strategy that treated them as short-term speculative vehicles rather than long-term stores of value. The billions reportedly lost highlight how dangerous it is to confuse physical ownership with paper exposure. Holding a gold bar in a vault is very different from holding a promise that someone else will deliver gold if conditions allow. As this story continues to unfold, the most important question isn't whether Yarport China survived or was rescued, but what this episode reveals about the future of precious metals markets. Are we approaching a moment where physical demand overwhelms paper pricing? Will China shift further toward domestic exchanges and physical settlement to reduce reliance on Western benchmarks? And for ordinary investors watching from the sidelines, should this event be a warning sign or an opportunity? The answers lie not in sensational headlines, but in understanding how leverage, currency risk, and confidence interact in the metals market. When confidence breaks, paper burns first. Physical metal simply waits, and that difference may explain everything because